Let's get right to the floor show. Joining me now, Advisor Group's Chief Market Strategist, Phil Blancato, and UBS Managing Director and Senior Portfolio Manager, Jason Katz. Jason, you got to call this what it is, and that is a rout in bank shares, regional but otherwise as well. What is the psychology here beyond the Federal Reserve?
I know this is anecdotal, but speaking with our clients who have money at some of these regional banks, they're basically saying, what's the point if I could move my deposits to a larger, safer bank? And it's hard to make the argument against that. So this is sort of a self-fulfilling prophecy. You have shorts stirring the pot, you have deposits exiting. But I think, unlike the great financial crisis, we're going to get to the point in the not too distant future where the market's going to push back on this, because this really is getting to the point where they're attacking aspects of the regional banking market that are in fine shape. And I think you will see a stabilization in the not too distant future. But to your point, yes, this is palpable and it's panic selling. It's probably getting overdone, but the pendulum always swings too far, and I think that's what we're witnessing.
We are going to scroll through some of them, most of them really, that are hitting 52-week lows or wider lows, longer lows. Truist Financial is among them, Valley National Bank. So, Phil, we don't want to sit here and look at this through the prism of a one single day or 1 week or 2 month loss that we've seen ever since Silicon Valley Bank imploded. Right now, will we, if we fast forward a couple of months, look at today as having been a brilliant opportunity to scoop up some stocks, not necessarily these?
Yes, without a doubt. And here's why. I really like the regional banks. The United States can't function in its capital infrastructure without what regional banks do. Think about what Silicon Valley Bank did. All those tech startups that have funded. So when you see some of them you mentioned, Valley National Bank, that's a good company with a great balance sheet. Look at that stock and say, I get to buy it 50% off or 30% off, depending on where it's trading in the last
year. But it could go under.
Under's a really broad statement. Here's why I don't buy into that. First, think about what the federal government has done by putting out areas of capital that they can access if they need it. Now, I know it sends off a red flag and suddenly everyone's going to flee them. But what happened here? Was this really more about investors finally taking advantage of higher yields and moving into money markets, squeezing deposits? Was it the bank making a mistake on what they did in their balance sheet? These are those moments when you nibble at some of these names because they're so inexpensive. And by the way, let the bigger money center banks sell off. That's even a better trade because all the money they make on cash. I think it's an opportunity. I really do.
Jason, the broader market, though, really has not exactly been lifting in its entirety. I mean, you look at the S&P, there are just a handful of sort of the weightlifters holding up the entire index. So tell us what you interpret from that.
Well, talk about the weightlifters. 80% of the performance of the S&P is coming from 7 stocks. So the other 493, where are you? So look, we've had large cap technology being the so-called safe haven trade because there's predictable earnings. You know, at the multiples they're trading, it's really hard to justify multiple expansion. So I would submit to you, you need to look outside of what has worked this year into other areas, such as dividend-oriented, such as value, where valuations are extraordinarily more reasonable.
Mm-hmm. Well, would that include the Microsofts and the Apples of the world, Jason? I mean, you watched today. Advanced Micro Devices did an absolute moonshot. I don't know if we can put up an intraday of AMD on a Bloomberg report that Microsoft is funding AMD's chip-making capabilities for artificial intelligence. I mean, look at this spike. This is unbelievable. So do you go with the sort of tried and trues of Microsoft and Apple, which, as we said, reports after the bell?
So, you know, we've gone from too big to fail to too small to succeed. So the larger companies, whether it's the banks or the technology, they'll continue to thrive. But at UBS, we're saying right-size those positions. We wouldn't add to them here. They've been the hiding place.
What does that mean, right-size?
Right size means it should be a market weight exposure at most. You want to bring it down to the exposure that sector represents as the 11 sectors that make up the S&P. We would not be overweight a sector that's done all of this heavy lifting.
Phil, what about you? When you look at tech and you look at those names that Jason just talked about that we're calling the S&P heavyweight lifters, is there a name in there in particular you pluck out?
Apple. I think you could, and I'm going to leave aside today, and what you opened with was spot on. You know, I like Apple right here, the opportunity in India. You got a 2-3 year opportunity to see the stock go to 210, 220 because of the opportunity to just penetrate a market that has nothing to do with their sales right now.
Right. They do not sell a lot of smartphones in India, but they're going to start producing in India. So they would produce what, a cheaper phone?
That's it. Buy the company on weekends. And by the way, to his point, I don't like the market here. It's come far too fast. buy the dividends, hang out, shelter down. Let's get through this period of Fed noise, regional banks. Probably got 3, 4, 5 more months of this. Our rally happens September, October. So this is your chance to hide or be paid to wait around. But an Apple right now is positioned to be a gigantic stock for
and by the way, they've opened 2 retail centers in India.
Huge.
That's only the beginning, right, Jason? But let's just kind of talk about what happens in the near future. If you look at the Fed funds futures, okay, June, forget it, 90+% odds that there will be an interest rate pause, not move. So we're at 5 and 5.25%. But if you flip that over to the September Fed funds futures, so there's the June, you go to September, and there is now a more than 50% odds that there will be a cut. Okay, 50.4%. This is the latest Fed funds futures here. So where's the benefit? What sector, what area do you say, well, that's going to benefit?
Well, I'd take the other side of that trade. This was the last one and done. The Fed could ill afford to go any higher and stay for a longer period of time. And they had this whole transitory talk and they lost credibility. They're not doing that the second go around. So all these people that are banking on another rate cut or 2 in the latter part of the year, they are dead wrong. So to Phil's earlier point, you could hang out. You could hang out in treasuries getting north of 5% or just high quality value and dividend oriented names and get a combination of dividend and some appreciation and have returns that are in the mid-single digit range. That's where I think the trade is.
Phil and Jason, great to have you both. Thank you so much.